Good evening, everybody. Let's begin. Takes us a while to pile into this Zoom-a-thon, so I have to wait for a majority of the class to come on board. Hope you're all well tonight. This is our agenda for this evening. We're going to talk about a wide ranging of subjects. Our theme for tonight is what happened. In other words, what does financial data tell the finance people to do their job? And that's the central theme of tonight. One of the key pages to refer to in regards to this is page 105 of your textbook, which is a summary of performance measures, examples of financial statement ratios and analysis that helps you study and prepare for what happened. So that's what we're going to try to do tonight. But before we do so, let me bring up something here. Last week, many of you did a very good job in posting a bio and a portfolio. I have asked some of you to resubmit your portfolios for just to clean it up a little bit, so we all start on an even footing to determine our Wolf of Wall Street for this summer term. This is my portfolio for the class, with my June 12th closing stock prices of Apple, Bristol Myers, Merck, and Walt Disney. Why I selected these stocks is pretty much because they have been in my portfolio for many years. And especially the times that we live in the coronavirus, Bristol Myers and Merck are going to be some interesting companies to track over the next few months, due to the fact that they're working on virus solutions, and should be interesting to see what develops with that. Apple Computer is Apple Computer, and Disney is Disney. There's not too many companies like those, and it's always a good thing to follow and to keep track of that. But a couple things to note for us going forward. Remember, this is going to be something that we're going to track. We're not going to track this on a weekly basis. We're going to track this a couple of times during the year. And how we'll track it is, what we'll do is we'll just make a copy of our portfolio and copy it on down. And as the prices change, we're going to multiply those prices times the amount of shares we originally purchased to see how our values change over time. Now, in this portfolio, that's why it's always important, and I sent some of yours back for fixing, is that the portfolio has to total $100,000. Everybody has to start on the same footing. So how do you get a portfolio to always be $100,000? Well, you assign the investment here, and then you determine the shares by dividing the price into the investment amount. So this is why some of you had pennies and dollars and not totaling 100,000, because you made the investment of the shares times the price to come to your investment amount. What you need to do, if you have not already done so, is take the investment amount that you select and divide the price into that amount, and you determine the amount of shares. If you look at my cell here, it's the formula is equals G6 divided by E6. And then it determines the amount of shares. Now, usually you'll get the number like this. And what I like to do is I like to round to the whole number in shares. So you go up to your menu and you click on the little arrow for decreased decimal, and you just move that over and it automatically rounds to the nearest whole number. So that's one of the issues, because now going forward, what I'm going to do is the next time we do this valuation, I'm going to copy this down to say here, and then I'm going to put in the new price as the new effective date and multiply that price times my shares to get the new value. And that's what you're going to be doing next in a couple of weeks. So that's how we'll go about doing this. Now, you do not have to track this every week. You do not have to track it every week. It's not mandatory. Some students like to do it just for the fun of it. but you do not have to track this weekly. We're going to do it about 3 times. The second time will be around the midterm, week 5 or 6, and the final time will be as a question in your final examination. So that's how we're going to handle this throughout the course. And during the course of the class, as the price change, we'll see if we're making any money or losing any money. And hopefully we make it. Another area of concern is I wanted to make sure you determined on June 12th the Dow Jones Industrial Index value. That index, matter of fact, is defined in week 2 Blackboard file folder. The definition of the Dow is included in week 2. The S&P 500, that definition was included in week 1's file folder. Here's the June 12th closing price. And the NASDAQ. The NASDAQ index is the closing price of June 12th, and that also is in week 3 file folder, the definition. But why are we doing that? Because we want to compare how these prices change from week to how our values are changing week to week. One of the typical expressions in finance is, did you beat the market? Has your company outperformed the market? Well, this is the market here, the Dow, the S&P 500, and the NASDAQ. And so we're going to compare how we do versus the market in our individual selections. And I must say, some of you had some very creative portfolios. I was quite impressed, very impressed. So if you have not equaled $100,000 on your portfolio, if you have not selected the correct Dow, S&P 500, and NASDAQ indexes, please resubmit your portfolio to get a grade posted for week number 1. And that's to keep that up to speed. So that's how we're going to be doing this going forward throughout our class. Remember, in this week 1, it's the investment divided by the price to get our share numbers. In the real world, it wouldn't work that way. In the real world, you would say, all right, buy 74 shares of Apple. They will buy you 74 shares at this price, but then they will take a commission out of that amount. So your true investment would be a little bit lower because of the commission being taken out by the broker, charging you a fee to do that service. And those fees can run from 0.25% to 1%, depending on the work that your broker or the firm is doing for you. Usually individual trading on Schwab or E-Trade is a lot cheaper, and that's why a lot of people do that. But you don't get the expertise and the knowledge that's supplied by that brokerage firm. So that's our portfolio, and that's what it looked like. So if you still have a grade that is yet to be posted for week 1, it's probably because you need some corrections to your portfolio, and please do that in the next day or so you can get a grade. All right. The second thing I want to do tonight is tell you about this week's assignment in the discussion post, of which many of us have already started and accomplished today. I spoke to 5 students today in our one-on-one sessions with that. And this is located in the discussion forum in our Blackboard site. Remember I told you, or I warned you last week, there's always a lot of stuff going on in this class. You can't check on the class one day a week and see what's going on, because if you do that one day a week, you might already have missed an assignment. You might already have missed something to do. So make sure you check in with this course, this Blackboard, every day or so, just to make sure nothing has changed or Professor Hashley hasn't posted some additional information for you. So if you go to the class discussion forum for this week, you'll see that there's now this week a student-professor meeting forum. This is for a grade. If you do not participate in this by Saturday afternoon, you get a 0, which represents 5% of your course grade. Again, this is my attempt to stay in contact with you, make sure everything is going right. And secondly, it's my attempt to see how you handle the technology. All right, how you handle it. That's just as important as reading the textbook and looking at problems in this class, is being able to keep up with the technology and the demands of it as being an online class. So if you notice here, I have already students who've already indicated to me the dates and the times that they're going to come on. You click on this link. The link is also in the Zoom links file folder, and you create a forum here and you say, Mr. Hassey, just like Catherine did this afternoon. She said, Mr. Hassey, can you see me at 2:40 this afternoon? Fine, Catherine, I'll see you then. Catherine came online on 2:40 this afternoon, and we had a little 5 to 10 minute talk about the class, about what we're trying to do here, and that's the purpose. As you can see, tomorrow I have a pretty full plate with Mr. Blair, Miss Newland, Miss Green, and a few other people tomorrow afternoon. Where there's an empty spot, those are the spots that you have yet to sign up for. Those are the ones you should go after. The reason I'm having Saturday, because I know many of you do work during the week and don't have time to see me during the course of the weekday. That's why I've allocated some time Saturday afternoon where you can click. But as I just said earlier, if you do not sign up and see me on Zoom before by Saturday, you will get a 0 for your class participation for this week. So this is an important thing. Don't blow it off. Okay? So sign up, and I'm sure tonight after class, or usually a lot of students do their own posting while I'm talking here, which is not too cool, but we'll let that go. And we'll post and select a class or select a time for it. I have a chat session here. Let's see what somebody's chatting. Leela G, this is not the time to clean up and do administrative tasks. If you want to ask me these questions after class, that is fine. I don't want to sound like a snob, but that is, don't say sorry. It's okay, no big deal. We'll deal with this. When we're done with class, I usually stay on for a few minutes more, and students can clean up any administrative issues or make an appointment with me. If you say tomorrow at 4:20, Leela, let's see here, 4:20 tomorrow? No, it's open. So that means you probably have that slot for tomorrow, okay? So that's what every one of you do. We right now have 27 outstanding students signed up for this class. 27, good Lord almighty. That's a lot of work for Professor Hassey. I'm gonna be earning my $12.50 an hour this class. So as we can say, so your job in the next day or so, well, you better hustle if you wanna get a time for tomorrow. And you better hustle to get a time for June 20th for Saturday if you want the appropriate time. Now, if worse comes to worse and you really better have a good excuse, Mr. Hassey, I just can't find a time by Saturday. Well, you let me know about that and we will try to fit you in at another time. But you're really going to have to come up with a viable excuse on that one, because every week, these first 4 weeks, I'm teaching 4 classes this summer. Every week I have these sessions assigned to the students in each class. So next week I'll be meeting with another class and doing the same thing. So time is kind of at an issue here in regards to these issues. So that's your assignment for graded work this week. Next week we'll have assignment number 1 on chapters 1 through 4, but there's no additional work for grading this week. I do have a little take-home assignment for you to do if you want to do it, but it won't be for a grade. It's looking at a financial statement of a company, and we'll talk about that a little later. So that's the work you need to do to keep me smiling. See, smile. Oh, there you go. Smiling if you sign up, and so I can talk to you personally. And I'm sure Maria, William, Ashley, Jose, and Catherine will attest. I'm kind of a dry sense of humor guy and kind of a boring to talk to, but it's something you all have to do in order to make sure that I feel comfortable that you are doing well and feel comfortable in taking on this class. There's nothing worse, trust me, to spend a lot of money to take a class, to go to school, or to borrow a lot of money, or have your employer pay for the class, and then it comes to week 7 or 8, and you have no idea what the hell you've been doing. That's kind of a waste. So that's why we try to clear that up as we do today, this week, to make sure you guys are aware of what's going on, feel comfortable, and are ready to accept all this mush I'm going to be throwing at you over the next 8 weeks. Okay. So we've taken a look at our portfolio. We've taken a look at our discussion work one-on-one with Professor Hasse this week. Now let's take a look at a little question and some questions from our earlier reading of discussion of last week in our textbook. So here I go. Let me find my textbook first of all, excuse me. There it is. And you can open to the textbook if you have it in front of you. If not, you can just follow along with me this evening. I'm on page 22 of your textbook. Excuse me, page 27. Excuse me, page 27 of your textbook. That's the end of chapter 4. And remember last week, I don't assign problems for homework, but I assign problems to review that I feel are important to review the material in the textbook and in my lectures. All right? Well, a couple of questions I have selected, and you saw them in the agenda on page 27, is question 3 and 6. To me, these highlight the key points of chapter 1. And I'm willing to bet, and also forget the betting, it's a sure thing. When you get your assignment 1 next week on chapters 1 through 4, you're going to probably have some questions about these questions we review tonight in class. Wow. Okay. Page 27. Question number 3, financial decisions. What is the difference between capital budgeting decisions and capital structure decisions? Ooh, that's a good one. What is the difference between capital budgeting decisions and capital structure decisions? Well, let's answer that. Mr. Hasse is firing on all cylinders tonight with the technology. He's going all over the place. All right. So first of all, before we answer this question, we might want to make sure we understand what is a capital budget and what is a capital structure. And then we can decide on what the difference between those two are. And these are two very important components, excuse me, gotta have a beer, hang on just a sec. Nothing better than finance and Budweiser. No, that's a joke. If anyone tells somebody that your professor is drinking on the class, that's not. This is an Arnold Palmer, iced tea and lemonade. Thank you. In week 6, it'll be a Rick Hasse, iced tea, lemonade, and vodka. So there we go. That's week 6, but we hold off until that. Okay. Now, some of you have probably already read about this in your tests, and some of you might already know about this through your own work experience, these definitions. A capital budget is a determination of return on an investment in an asset. It's an analysis to determine whether we're going to make money on an investment in an asset, a capital budget. I'm sure a lot of you work at your companies, and I know William, I see William because his picture is right in front of me here, and I know William works at Behr Paints, and that's a very viable corporation. Every corporation has what is called a capital budget. And what they do, it's an investment in assets. They determine, should they buy a new building? Should they buy a new assembly line? Should they buy a new paint thinner or whatever, however they make paints, whatever, okay? What should they buy? Well, that decision to buy an asset is determined by, is it going to make money for them? All right, is it going to make money for them? And a capital budget is that process of determining whether it's going to make money. All right, it's an investment decision. It's a strategic tool to determine an investment. And then we have capital structure. Well, capital structure is how assets are funded. Oops, my spelling there. Assets? Well, sometimes assets are assets. All right, sorry about that. How assets are funded. Remember last week we talked about there's three legal ways. There's a lot of illegal ways, but there's three legal ways to finance an asset. Debt, equity, profit. That's capital structure. That's the definition of capital structure. Debt, equity, and profit. All right? That balance of where you borrow money, you issue stock, you get Shark Tank money, you get an angel investor, or you make a profit, that money finances the left-hand side of the balance sheet. That's the right-hand side of the balance sheet. Debt, equity, and profit. So that's what we mean by capital budget. Capital budget is the determination once we finance that asset from the capital structure, is it going to make money for us? There's a lot of people around the world who get paid an awful lot of dineros to make those two decisions. Should we invest in an asset, and are we going to make a profit? And two, how are we going to pay for it? How are we going to pay for it? You do those things right, you're going to make a lot of money in your career. If you're an entrepreneur and starting your own business, those are the first two key things you got to do in order for somebody to invest in your company. In a business plan, you got to prove to them you're going to make money. And I need your money to be my capital structure. All right? Well, going back to the question, as it said, I lost it. Hang on. There we go. The question said, what is the difference between capital budget decisions and capital structure decision? What's the difference? Well, the difference is the timing. All right, the difference is the timing. The difference is the timing in that. I'm going back and forth the slides here, and if I'm talking about a slide that you guys don't see, somebody yell at me. All right, William, I see you, and Ashley, and Ben, I see you. If slide's not matching what I'm talking about, you guys give me the finger or give me something and tell me that that's not working, because I'm going back and forth here. Okay. So the difference between capital budget and capital structure is the capital budget is the determination of whether you should invest in an asset because you've determined it's going to make you money. That's one. Number two, the difference is the capital structure is how are you going to fund that decision. And those are the two main reasons of the definition of working in finance. What does the finance manager do? He determines what to invest in and how you're going to pay for it. And that's question 3. That's a very important theme or mission of the first chapter. What do we do in finance? What's the purpose? We do capital budgeting. We do capital structure. Okay, that's a good one. I still see a lot of people going in and out of this class. What's going on? Is there a party somewhere and I'm missing it? What's going on here? All right, let's go back to our deal here. There we go. Okay. Now let's look at question 6 on page 27. All right. This is a little, all right, now I got all you guys on my screen. So now I'm gonna call on one of you guys to give me the answer. All right. So be ready with the mute button on your computer. I'm going to ask one of you guys about the answer to each one of these. So be on your toes here. The question is, choose in each case the type of company that best fits this description. All right, it tells you either it's a private or public, private or partnership. Okay, you guys got to determine that. And Edith Roman, you are first up, young lady. Edith, talk to me. Question A, the business is owned by a small group of investors, private or public corporation?
That would be small group, private corporation.
Very good. Usually a small group of investors would be a private corporation, something like you'd see on Shark Tank. All right, a small little group of investors. Very good, Edith. Thank you. Now turn your mic off. I don't want to see you the rest of the day. No, I'm teasing. All right, very good. Well, let's go to another group here. Christine Green, welcome to the madness. Christine, Look at letter B. The business does not pay income tax. Private, corporation, or partnership. The business does not pay income tax. Ooh, that's a good one.
That's a
Christine.
good one. Oops. Wow. Is it a private? I don't know.
Don't say that. No, wait a minute. You gave an answer and then you said, I don't know.
Yeah.
So is it I don't know or is it private?
It's private.
It's private, and that's exactly right. You win a round trip ticket to Yucaipa. So good luck. Congratulations with that. All right. So exactly, a private corporation. Wait a minute. A private corporation doesn't have to pay tax. Well, the private corporation doesn't, but the individuals individually who own that private corporation have to pay tax on their personal individual returns. All right. So it's taxed differently. Private corporation does not have a private tax return. They have individual tax returns of the owners of the company.
Okay.
So that's how that all works. All right. Benjamin or Ben Marquis. How about letter C? The business has limited liability. Ooh, we talked about this last week. The business has limited liability. Sole proprietorship or public corporation. Mr. Ben.
Wait, can you repeat that question? I'm sorry.
You don't see it on your screen?
No.
You don't see it on your screen? Why didn't somebody yell at me that it's not on your screen? Here I just said about that. Lupe, what's going on there? Keep track of me here. All right, let's bring this back up. Sorry. You guys got to talk to me on this. All right. Erica, you see it? All right. Ben, where are you here? Ben, there you go. All right, Ben. Letter C, the business has limited liability. Sole proprietorship or public corporation? What do you think?
Let's see. Public corporation.
Exactly right. Ben wins an all expense paid trip to Claremont, California. Ben, talk to me after class and I'll send you the details. Of course, you have to drive, you have to pay for the gas, and you have to pay for your meal. So I would not take advantage of this trip if it was offered to you. All right, very good. A public corporation, and we talked about this last week. If somebody walks into your sole proprietorship business and trips and knocks their head and has a concussion of a sole proprietor business, they can sue the business and the individual who owns the business. They can sue you directly. But in a public corporation, if that happens, you can only sue the assets of the corporation. You cannot sue the people who run the company. You cannot sue the shareholders. But this brings up an interesting case, and I don't know if any of you are following this, but I know we do have some Southern California gas students in our class. Maybe not in this one, but I do in some class. But if any of you have been following the news today, Pacific Gas and Electric has just pleaded guilty to criminal charges of manslaughter for the fire that they caused in Northern California at the Camp Fire in 2018. Here's a corporation that just pled guilty to a corporate or a corporate crime. Who's going to go to jail on that one? The shareholders? The president of the company? That's going to be an interesting thing to see how that develops. But in the case of this question, the business, and Ben was right, the business that has limited liability is a public corporation. You can only sue certain aspects of that company. Excellent. All right. And let's look at the last one. Anita Newland. Anita, turn on your microphone and come on down.
Great.
Anita, question number 6, letter D. The business is owned by its shareholders, partnership or public corporation?
Public corporation.
Public corporation. Very good. Excellent. Boy, you guys are sharp. All right. So that's key definitions of talking about the definition of equity, the definition of holdings in corporations or private businesses. A business that is owned by a small group of investors is a private corporation. A business that does not pay income tax is a private corporation. The business has limited liability, that's a public corporation. The business is owned by its shareholders, that's a public corporation. So very good, excellent. Those are some key definitions from chapter 1. All right, now if you give me a break, we're going to head on over to chapter 2. So just give me a break here as I slide on over to chapter 2. Okay, let me bring this up. Vince Wainwright, are you there? Vince, talk to me. As I figured. Okay, I'm on page 52 of your textbook now, 52. All right, page 52. At the end of chapter 2. Remember, chapter 2 is about the financial markets. I went to Vons this morning to get some iced tea and some other sundries. I went to the market. Why did I go to the market? That was the place where I could trade for sundries, for products using my capital, my cash. The financial markets are the same thing. The bond market, the stock market, the currency market, the money market. These are all places where you as an investor and a company can go and look for capital. Issue securities in those markets. In return, they get capital. So that leads me to the first question on page 52 for this distinguished group. How can it's question number 1, corporate financing. Question number 1. Ben, do you see that on your screen? Give me a thumbs up, Ben. Attaboy, thank you, sir. The stock, how can a small, I got a chat here. Maybe make sure to avoid any problems. Okay, thank you. Corporate financing. Question 1, how can a small private firm finance its capital investments? Give 2 or 3 examples of financing sources. In other words, a small private company does not have access to the United States stock markets. A small private company does not have access to the bond markets. Those are only reserved for the big ticket items, the companies with a lot of credit, a lot of assets, a lot of collateral. But if I wanted to go on Shark Tank, I just gave away one of the answers. What a dope. If I wanted to look for small financing and I was a small firm, what are 2 or 3 examples? So Ashley Grimm, give me one example of how a small business can fund its operations.
By taking out loans.
What kind of loans?
A small business loan.
Very good. Small business loans. Thank you, Ashley. Very good. The Small Business Administration, if anyone's ever heard of it, it's been in the news a lot during this COVID-19 situation. They're the intermediaries between the federal government supplying capital to the small businessmen and women. The Small Business Administration, small business loans. What's a small business loan? A company can get a certain amount of money and the loan is guaranteed by the federal government. It's kind of like a guaranteed student loan. If you don't pay, the government picks up the tab. But you better pay. Screws up your credit. So that's what an SBA loan is. That's one of 3 examples that a company can get gets financing. Very good. Kathy Campbell, what's a second example of financing for a small private firm? Kathy Campbell? Going once. Bueller, Bueller, Bueller. Kathy's probably sending me a chat saying, I'm sorry, it doesn't work. Oh, that's right. She has no microphone. What kind of a student does not have a microphone? I'm teasing Kathy. Okay. Veronica Anea. Veronica, come on down. Give me another example of a small private firm ways to finance themselves.
Would you be able to count someone who finds like a partner that will invest with them?
Okay, individual investment. Very good. Thank you, Veronica. You can find, you know who you can find? You know what all the big sports figures are doing now? Besides crying in their beer about not getting paid by playing baseball, they're investing. LeBron James is an example of Veronica's example. LeBron James. All right, LeBron James invests in hundreds of businesses, in like small and private companies. He gives them seed money. LeBron James. A lot of professional athletes do that. A lot of private investors, a lot of retired people with extra money invest in small businesses. That's exactly right, Veronica. So one example, as Ashley said, is SBA loans. Another example, as Veronica, is small individual investors. And sometimes there's a name for those people. They're called angel investors. Angel investors. They come out of the blue, like LeBron James, because they like what you're doing and they invest in your company. Angel investors. That's number 2. Excellent, Veronica. Thank you. And now let's go to Mr. Dustin Keefe. But before you answer this question, Dustin, what in the hell is that background behind you? Where are we? Is that Paris?
Yeah, it's Ratatouille.
Ratatouille. Oh, my wife would love that one. She loves that movie. Ratatouille. Very nice. So, Dustin, what is the third example? Give another example. We've talked about SBA. We've talked about individual or angel investing. What would be another example of funding a small business firm?
Redistributing your profits towards what you need to invest.
What happens if I'm not making any profits?
Then obviously, how are you in business if you have no profit?
Well, you might be a startup.
If you're a startup, then you'll probably want to have like a maybe your own capital.
You're self-financing. Very good. That's the third. Exactly right, Dustin. You finance it yourself. You know, a lot of times you see all these investors who start out with Facebook and Cisco and all these companies, and they make a ton of money, and then they say, all right, I'm selling, I'm getting out of here. And what do they take their money? They start up another business. They start up new ideas that they have. It's your own money that you invest. Very good, Dustin. Thank you. And Ratatouille to you all. That's good. All right, I got a chat here. Hang on. Carl brings up a good point. Could you also collaborate with other firms? Well, Carl, that can be very dangerous. Why? Because this is your idea. A lot of times when you go in cahoots with another company, somebody either steals your idea, tries to, excuse my language here, ladies, tries to horn in on your business or start telling you what to do. That can be very dangerous. All right. But yes, you could partner up. You could seek financing and merge or do some business with another group. But that's getting into dangerous territory. But that is another example. But the three that we've mentioned tonight, I'd remember. SBA financing, individual or your own personal financing, and angel investing are three methods that a small firm that can go outside of the general big markets that corporations get financing to find capital. All right, very good. Well, let's continue on in this chapter 2 to the bottom of page 52 to question number 7. Question number 7, all right? And that question is entitled corporate financing. Okay, corporate financing. Erica Rico, letter A, choose the appropriate term to complete each sentence. Households hold a greater percentage of corporate equities or corporate bonds. What do you think?
One moment while I look up the
You can go to LO 2.2 and find the answer very quickly in your textbook. But I was hoping you might know that off your top of your head, but please continue if you're looking it up.
I don't know it off the top of my head. I am looking in my glossary. We've got the corporate equities. Okay, not listed there, so I'm going to go back over here.
Now, households mean people like you and I.
Yep, individuals.
Right.
I'm trying to remember the difference between the equities and the bonds.
Okay, you have 10 seconds.
No pressure. I will go with bonds.
Incorrect. All right, but that's okay. Households, mostly, the greater percentage is in equity, stock. Bonds are mainly from insurance companies, big investment houses, insurance companies. All right. When you buy car insurance and when you buy auto insurance, when you buy household insurance and you buy life insurance, you know what those insurance companies do with your money? They invest it in corporate investments and bonds. And they match those length of those bonds by how long they expect you to live, your actuarial tables, and they invest it. But individuals or households, they have more of their money invested in stocks, individuals. Now that could be a 401k plan, right? Or it could be mutual funds that you invest in, or just putting money into a college fund for your children. But households hold a greater percentage of corporate equities is the answer. Very good.
Okay, having the bonds with the insurance makes more sense.
Very good. Let's look at letter B in question center 7. Lupe, pensions, funds, or banks are major investors in corporate equities.
I want to say banks.
Well,
No.
that's a tough one because it depends how you look at it. And the answer in the book, or the book that what they show me, is pension funds. Okay, but the banking industry has changed so dramatically in the last 10 years, where a lot of banks, through investment banks, are investing into corporations through through hedge funds and that sort of thing. But the correct answer, and this is what they say in the book, is that pension funds provide a lot of investing to corporate entities. You know, Apple Computer is owned, about 15% of Apple Computer is owned by the California Teachers Retirement Fund. That's one of the largest pension funds in the world, is the California Municipal Employees Pension Funds. And they own a lot of stock in a lot of companies. That's an example of that. So very good, Lupe. Thank you. Let's look at this letter C, the final one of this. And let's pick on this one. I'm running out of spaces here. Miss Rubio, question number 7, letter C. Investments banks, commercial banks, raise money from depositors and make loans to individuals and businesses. Investment banks or commercial banks? Go.
Would that be commercial banks?
That would be commercial banks. You're exactly right. Investment banks basically do the same thing, but they don't get their money from depositors. They get their money from big-time pension funds and corporations. But you're exactly right, Ms. Rubio. Commercial banks raise money from depositors, and then they make loans to individuals and businesses. Like if you put money in a bank account, the next day that money might be lent out to somebody's car loan. And that's exactly right. Thank you. That's very good. Thank you. Now, the last one that we're going to look at chapter 2 before we take a little break is question number 8 on page 53, the top of page 53. Which of the following are financial markets? Mr. Blair, is NASDAQ a financial market?
Yes, it is.
It is. Very good. Joe Regas, Is the Vanguard Explorer Fund a financial market?
No.
Very good. It's a form of an investment in a financial market. Very good. Leela G, is JP Morgan Chase a financial market?
Yes.
The bank JP Morgan Chase is a financial market.
Oh, wait, no. It's a form of investment. Yeah, no.
Well, it's an intermediary in a financial market.
Intermediate, yeah.
They do work for you in a financial market. Very good. And then finally, Elena Guzman, Chicago Mercantile Exchange. Is that a financial market?
Yes.
It is. Very good. Excellent. Chicago Mercantile Exchange, where you can buy commodities and options. And here's a little trivia for you all, if any of you are old enough to understand this, is that the Chicago Mercantile Exchange was started by the father of President John Kennedy, Joseph Kennedy. He invented the Chicago Mercantile Exchange in the 1930s. And that's how the Kennedy family got all their money, by owning the Chicago Mercantile Exchange. And to this day, they still own a big chunk of that exchange, and some Kennedy grandchildren are running it. A little trivia for you there. So exactly right. The market is the places where you can go and buy and sell securities with other people. NASDAQ and the Chicago Mercantile Exchange is one of them. Vanguard is an investment vehicle. JP Morgan funnels funds into the financial markets. So questions 1, 7, and 8 give us some examples of chapter 2. Questions 3 and 6 in chapter 1 give us some definitions of chapter 1. And if you understand and remember those questions and those answers, that can be a good assistant for you next week in assignment number 1. Okay. Now I want to bring up one thing before we go on break. So that's that. Moving right along here. If you go into your Blackboard, into week 2, click on week 2, you'll see this week's topic, financial statements and analysis. There's my introduction video of a couple of days ago. Very nice to have, Professor. Matter of fact, this is bad news. I'm wearing the same shirt I did yesterday. That's not cool. Ladies, you should take note of that. Professor Hasse has no fashion sense. I need to start watching, what are those fashion shows on that channel? I can't remember the name of them. But look at that. Professor Hasse, see, here he is. There's my shirt. And look at the video. Not cool. All right, sorry about that. But also, besides not looking cool, here's our agenda, here's our definition, and this is the key thing here. This week we study financial statements and what they can tell us about a firm's performance and analysis and the relationship to their competitors and the industry they are in. The 4 main financial statements you should be familiar with, and this is from your days of accounting and all that other nonsense: the balance sheet, the income statement, the statement of owner's equity, and the statement of cash flow. All right. And then I go about talking about these, a definition of these things. Well, this is what we're going to concentrate on the balance of our class this evening. These 4 financial statements, and they tell us what happened. And in finance, we now determine, all right, what do we do next? We don't have any money. Ooh, I guess we better get some money. How are we going to get it? Oh, we have a lot of money. I guess we better invest it. How are we going to do that? That's what we're going to be talking about in this week, financial statements and analysis. And if you go back up into that file folder, you'll see a file folder there called Week 2 In-Class Review. And if you want to right-click that and download it to your computer and follow along with me tonight, you're more than welcome. If not, you're going to refer to this file after class tonight to do some analysis and work in regards to this company's financial statement. So if I bring that spreadsheet up here, this is what it looks like. Right here. It gives you the financial statement for a company. Its name remains nameless, but this is a real live company. It gives their financial statement for 2018 and 2019. It gives their balance sheet and their income statement. Oops, that should be 2019 and 18. I apologize there. But this gives their balance sheet and their income statement. And also, if you click on this tab, it gives their statement of cash flow, which we'll talk about at great length after our break. And then finally, the last tab is statement analysis. And that's what you guys are going to work on after class to do a little bit of work on to learn what these key ratios do. And this is what I was talking about, page 105 of your textbook. If you go to page 105 of your textbook, in chapter 4, this is edition 10, by the way, you will see table 4.6, and it's a summary of performance measures for Home Depot. But the key thing that you have to remember here is all these performance measures here, and these are discussed in chapter 4. One of the things I'd like you to do in our rest of the week, besides talking to me in these individual sessions, is see if you can do a financial analysis for 2018 and 19 of this company. And we'll talk about these a little bit later. But first, before we get to that point, we're going to review these financial statements of the company and refresh our memories on what they tell us about a company. One of the key things in finance is being able to use accounting data to give us the data that we can make financial decisions. And for us, one of the key statements in this is the statement of cash flow, where our cash comes from. All right? And we're going to be talking about that. I call the statement of cash flow, if any of you have ever bought an automobile, one of the first things you do before you buy a car is you open up the hood and you look at it. The engine looks pretty good. Then you turn it on and you listen to it. Oh, that engine sounds nice. Well, the cash flow statement for a company is looking under the hood. For a company. You're seeing the details of how they operate the business. So we're going to take a break right now for about 10 minutes. And when we come back from break, we're going to take the information that was given to us definition-wise in chapters 3 and 4. And we're going to look at a couple of problems in chapters 3 and 4. And also take a look at this real-world financial statement. It's still kind of simple, as you all will find out. You're going to do an exercise next week, or in 2 weeks, in your assignment number 2, where you're going to be taking a look at a company in your portfolio and looking at their financial statements, but that's still a couple of weeks away. So when we come back from break, we'll take a look at this company and do some work with it and learn about and refresh our memories about financial statements and measuring performance at a company. So let's take a break. I'll see you all at about 10 minutes after the hour, 7:10. Thanks, everybody. See you then. Okay, we're back. Dustin, thumbs up. Did you hear that music that was playing in the background a few minutes ago? Did you hear some music? Okay. What is that thing next to you, please, sir? What is this?
It's Big Hero 6.
It's who?
Big Hero 6.
Boy, I don't know that one. Explain that, please.
So it's about this kid who his brother dies, and then this is the robot that his brother created, and it's a helping bot. So it helps people, it like saves them.
Oh.
Well, he ended up trying to hunt down this guy who stole his microbots, and he uses this guy to help him.
Is this a movie, a television series? What is this?
It's a movie. I think it's a television series too on Disney XD.
Oh,
Not
shows
sure
you.
which one.
It's
I
based
guess
on a comic book.
It's
okay.
based on a comic book. Thank you. Okay. Boy, talk about somebody who's out of touch. That's me. Okay. Thank you. Kind of cool. And it's entertaining. I take it.
Yeah.
Okay, good. Erica, you know all about it?
I like that they did an animated version instead of a live action version because it would have been hard to do what they did.
Okay.
But my husband's really into a lot of those comics.
Oh, very good. Okay, good. All right. So let's pick this up. As we looked at before break, we are looking at financial statements, Chapter 3. And it's important for us. I know I might be boring some of you with some of this. You probably know this very well. But some of us who haven't taken accounting in a while, or their careers do not have them look at financial information very much, this is probably be a good review for you. So for those who already know a little bit about this stuff, I might throw a couple things at you that you might not know. So let's see how this works out. This, as I said, is a financial statement of a company, a real world company, and I've dropped a few zeros here and changed a little bit of numbers to keep it a little bit simpler. Naturally, most corporations have a little bit more than $3.5 million of assets. So if you can imagine, I've dropped a few zeros here and kept it kind of simple. But this is a company's financial statements as of December 31st, 2019, for the year ended December 31st, 2019. On December 31st, their stock price was $12.17 a share. On December 31st, 2019, they had 250,000 shares of stock outstanding in the market. Now, what does that mean? They have issued 250,000 shares of common stock, and 250,000 people, individuals, pension funds, whoever, have purchased it and own it. All right. Their tax rate of this company is 40%. In 2018, the stock price was at $6 a share. They had 100,000 shares of stock outstanding, and their tax rate was the same. One interesting thing to note there is it looks like in 2019, they issued 150,000 more shares of stock. They got some more equity in 2019. They issued more shares of stock, sold them. Well, we'll see that in the balance sheet. Here's the balance sheet. Remember, the balance sheet is a statement of what you own, what you owe, and how much is the ownership position of the company. Assets, liabilities, and equity. And remember when we talked about earlier about capital structure decisions in Chapter 1, this is the capital structure of the company. It's debt and equity position. That's the capital structure of this company. Notice, $3.5 million of assets, $3.5 million of liabilities and equity. And in a true financial statement, this is called a detailed financial statement because it breaks down assets and liabilities into current and long-term or fixed. Current or long-term. In other words, how long is the life supposedly of these assets? Well, in 2019, they had $2.7 million of current assets. Current assets mean they have a lifespan of less than a year. They come in and out of the company rather quickly. Cash, short-term investments, accounts receivable, and inventory. Accounts receivable is what people owe you for the inventory you sold. And inventory is the product you have on hand at the end of December that's waiting to be sold. Inventory. $2.7 million of current assets. And then they had $1.2 million of fixed assets. That's property, plant, and equipment. Fixed assets, of which they have depreciated $383,000 of it accumulated through December of 2019. Thus, the net fixed assets is the difference of what they paid for those assets and what they've depreciated, $836,840. So this is the company's asset position. These $3.5 million of assets create the sales. Those assets create the sales. Those assets are funded by current, long-term, and equity of the business. Let's take a look at that liability. It's broken down into two areas. Current liabilities, in other words, this debt is due within the next year. All right? This debt is due in the next year. Accounts payable and accruals. Accounts payable, you know all about that. You go to Staples, you buy a product, you buy some supplies, you put it on your checking account, on your credit card, or you say, send me an invoice, it's due in 30 days. Accruals, $380,000. What's an accrual? I owe taxes. I owe payroll taxes. I owe sales taxes. I accrued something. In other words, a service has been provided you and you owe the money, or you owe the service. It's another short-term debt. And then notes payable. Well, this is kind of confusing because a notes payable is usually long-term debt. You've signed a note over many years to pay it back. But this is the current portion of the long-term debt that's due this year, $300,000. Whenever you see notes payable, that's an interest-bearing debt. You have to pay probably interest on that. Whereas accounts payable and accruals, there's usually no interest involved because you pay it when it's due. Notes payable is the current portion of long-term debt. Then we get into the long-term liabilities. Basically, it's one, bonds. $500,000 of long-term bonds. A bond is a obligation to pay over a period of over time. The nice thing about a bond, it's an unamortized loan. In other words, you only have to pay the maturity or the principal at maturity. It's interest only until maturity. That's the nice thing about bonds. You and I don't have any unamortized debt. All our debt is payments every month. Mortgages, car loans, student loans. You pay it every month. And in that payment of every month, you pay principal and interest. That's called an amortized loan. Corporations have a lot of unamortized loans. Why? They have better credit and they have better collateral to back up that debt. What's our collateral for a car loan? If we don't pay, they take the car away from us. What's our collateral for a mortgage? We don't pay, they foreclose on the mortgage. For a corporation, if you don't pay, you sell off an asset and pay the creditor. You have assets backing up your collateral. So a long-term bond is a long-term debt that's owed over many periods, but the $500,000 is due in the future and you're probably paying interest only on it now. So notice you have a total debt position of $1.5 million. So $3.5 million of assets is covered by $1.5 million of short-term and long-term debt. The problem with this, you have a lot of short-term debt, over $1 million, and that is a little creepy. It's just like what happens to your FICO score if you get a lot of accumulated credit card debt and you're paying it off in installments. The credit companies get a little antsy saying, you know, why are you doing this? Why are you taking out all this debt? And gets a little whacked out. Then we have what is called equity. And equity is in the form of two things for a corporation: common stock and retained earnings. Common stock and retained earnings. Common stock is the book value of stock you've issued. Now notice, we had 100,000 shares of stock in 2018 and 250,000 shares of stock in 2019. That's a variance of 150,000 shares of stock. Well, what did we issue those 150,000 shares of stock at? We'll look at the variance in the common stock balance from 2019 to 2020. $1.22 million. That's what we received in cash for issuing those 150,000 shares of stock. Let's take a look at that. What would that be? If we take the 1,229,36 and divide it by the 150,000, that means we issued the stock at approximately $8.14 a share into the market. So we started out the year at $6. We issued 150,000 shares and got $8.14 a share, which transfers into $1.2 million. And now the stock is trading at $12.17. Oh, I bet you our investors are happy. They've made some money this year. See how that, it seems like a very complicated analysis, but it's really quite simple. That's the equity position. And now here's another one of the equity positions, and think back. Put on your accountant cap. Where's my accounting cap? Where's my accounting cap? I left it. It's not here. I had a cool accounting cap. Damn. Oh well. Put on your accounting cap. What is retained earnings? Remember in accounting when you close the books. Remember those dreaded journal entries? All right, student, close the books. And you close all the revenue and expense accounts to retained earnings. The definition of retained earnings is cash, or excuse me, profits less dividends that you have accumulated for the life of the company. In other words, at the end of December 2019, this company had retained cumulatively $296,216 in capital. That's what they've kept. And that money has probably been reinvested back up here. Now, how did this, let's look at the delta of this. $198,584. All right, we'll come back to that number a little bit later. So that's the balance sheet of the company. A key point of this balance sheet, which we'll see in the cash flow statement, is what is the delta between beginning cash and ending cash. This company created $6,718 of additional cash in 2019. This number is what makes up the cash flow statement. And we'll look at that in just a few minutes. But as I said earlier before break, this is looking under the hood of a company. As financial people, business finance, financial managers, our job is not worrying about the debits and credits and how these numbers got here. Our job is to decipher, interpret, and what does this information tell us about the company? As a manager, as an investor, as a customer, as a vendor. All four of those groups are concerned that this company in some way is doing well. A vendor wants to get paid for the goods and services they provide this company. A customer wants quality products that they produce. An investor wants to make money. An employee wants to be working with a company that's growing and going to pay good salaries. Financial statements tell something to all these four groups, and that's what every business administration major should understand. It's telling us a story. It's not very attractive, but it's telling us a story. And here's the income statement. Remember, the balance sheet is on a given date, December 31st, 2019. This is our financial position. An income statement is for a period of time. Okay, let's change this right now because this is driving me nuts. 2018, 2019. All right. So for 12 months ended December 31st, this company generated a profit of $253,000. Last year on December 31st, 2018, whoops, They lost $95,000. Of those profits, they paid out 22 cents in dividends. Last year, even though they lost money, they still paid out 11 cents in dividends. Why in the hell would a company pay a dividend if they lost money? They want to keep the shareholders happy. So if they can afford the cash, they'll pay them a dividend even though they lost money. So that brings us back to retained earnings. Notice the profit was $253,584. Well, that's not the increase in our retained earnings. Our increase in retained earnings only was $198,584. What's the difference between that and $253,584? 22 cents a share in dividends. If I take that 22 cents and multiply it by 250,000 shares of stock, I get $55,000 in dividends. So if I take my profits for 2019 of $253,584 and I subtract out the $55,000 dividends that I paid out to my shareholders, I get $198,584. And when this company's accountants close their books, they close the revenue, expense, and dividend accounts to retained earnings. And this is where the income statement matches the balance sheet. The profits you retain after dividends increases the retained earnings balance of your corporation. And that's part of the equity position of the company. These assets are funded by debt, stock, and profits. There you go. It's like that for every corporation in the world. It's just some corporations have such technical and a lot of accounts. It's sometimes going, this sure doesn't look like what Mr. Hassey showed me last week. But it is. It's just a little bit more complicated in detail. So there's a quick 15-minute refresher of what you always wanted to know about balance sheets and income statements, but were afraid to ask. But the most important statement for us, Business 330 Professor Hassey's finance class, is the cash flow statement. The cash flow statement. Where did this $6,718 come from? How did we generate an increase in cash flow? And it comes from, as explained in chapter 3, it comes from 3 areas: operations, financing, and investing. The combination of those 3 total to $6,718. That's the statement of cash flow. Operations, financing, investing. And all it is, it's the delta between all these accounts. The change from 2018 to 2019. If I go through here and bring this all the way down, you'll see these numbers on the cash flow statement. Short-term investments, a delta of $51,632. In other words, we invested $51,632 more dollars in short-term investments. Where would that be on the cash flow statement? Right there, investing, short-term investments. We spent $51,632. All these numbers are from the deltas on the balance sheet and the income statement. That's the cash flow statement. If any of you ever heard of these 2 companies, Oracle, which is based up in Northern California, Oracle, and SAP, S-A-P, SAP. Those are 2 companies that take accounting data and download it so you can so you can figure out your cash flow statement. Oracle and SAP, they provide business applications to take raw accounting data from a company and create information documents so they can manage their business more efficiently. SAP is based in Europe, Germany, by the way, and Oracle is based in Northern California, and they fight it out in the corporate world to have their applications be used by companies. The San Bernardino School District uses SAP. The City of Los Angeles uses Oracle. University of Laverne uses Oracle. All different companies use these softwares to apply and provide this information. It's a big business. Go to work for Oracle. That's not a bad gig to work for if you can get a job with them. Trust me. Notice accounts receivable. It had a delta of $245,840 from 2018 to 2019. That means the receivable balance went up. Where is this number in our cash flow statement? There it is, right there. Under operations, accounts receivable, negative 245,840. Wait a minute, Mr. Hasse. Why is that a negative? It shows on the balance sheet that it's an increase. Yes, but think what receivable is. Accounts receivable is money owed you, right? If that balance goes up, that means you've lost that cash. Now, hopefully you'll collect it pretty soon, but as of December 31st, that's $245,840 of cash that we don't have that we should have. And that's why it's negative here. Cool. Look at inventory. Inventory went from 1,287,000 to 1,716,000. That's a delta of 429,000. Inventory went up. That means we spent money on product and we've yet to sell it. There it is right there under operations. Negative 429,120. Not good. That's why, ladies and gentlemen, every friggin' day on television or in the newspaper, you see Macy's has a sale. All the automobile companies have a sale. Why are they advertising? To reduce and get out their inventory. When they sell inventory, that's when they get the cash. If it's just sitting on their shelves or in their parking lots or in their warehouses, that ain't happening. Ladies and gentlemen, that's the reason why Walmart, Target, Costco, and Amazon are some of the richest companies in the world now. Why? Because through their distribution systems, they can control inventory. And they always have just enough so they can ship out or put on their shelves, but they control it. They only put on their shelves or in their warehouse what they think they're going to need from their customers. No wasted money, no wasted cash flow. Some of you are going to be probably majoring in your business administration program or concentrating on supply chain management. Ooh, huge. Supply chain management. The process of making sure you manage your inventory correctly. Supply chain. And Amazon, Walmart, Target, Costco do that better than anybody else. And that's why they're so friggin' rich. They do that. It's amazing. One of the coolest things you should do, if you can, I wish we could do it through Laverne, is take a tour of the Amazon distribution centers in Ontario. The one in Cucamonga caught on fire the other day. I don't know what's going on there. But the distribution centers in this area. And every now and then they offer tours. And you go into those buildings, and one of the first things you see when you walk into an Amazon distribution center, it's friggin' freezing. It's like 40 degrees. With all the computers and the technology going on in that facility, they have to keep the temperature cool. And you see all the workers working with heavy coats. Hold a minute. We have an Amazon employee here. Where is he? Benjamin, Ben,
Yeah.
talk to me about Amazon.
Oh, I don't work at one of those. I just work at a cross dock for
Well, the hell
Amazon.
with you then. Shut off your mic. I don't want to hear from you.
Not-
I'm teasing you. Oh, okay. Well, haven't you ever visited those facilities?
No, I never visited a facility before. I'm pretty useless when it comes to that information.
No, you're not useless, Ben. Don't say that. You need to expand your knowledge of Amazon. Correct?
Yeah, I suppose.
Okay. Do you own stock in Amazon as an employee?
No,
What's your favorite television show, Ben?
I don't watch television.
What's your favorite newspaper, Ben?
I don't read.
Ben, I'm drawing at straws here. Ben, if you would have a cocktail, what's your favorite cocktail?
I don't drink. I'm sorry.
Don't apologize, Ben. You have the makings of a wonderful financial analyst. Trust me. All right, thanks, Ben. I'm sorry about that. But again, if you go into Amazon, it's cold and there's no people. It's all computers. It's all robots. They have maybe 100 employees. It's amazing. Supply chain management. It's amazing. Okay. So that's another sideline. But back to this. So these are all the deltas of the balance sheet accounts. Let's do this here. Watch this. I'll go down into this side of the financials. Look at the delta in accounts payable. We increased our liability in 2019 in accounts payable by $35,800. Where is that in the cash flow statement? There it is. Accounts payable, $35,800. And that's an increase in cash. Wait a minute, Mr. Hasse. What is going on here? You owe more money. That's an increase in cash? Yes. Why? I haven't paid it yet. I've been given services and I've received those services and I haven't paid it yet. It's an increase in cash flow. Look at notes payable, $420,000 paid. Went from 720 to 300, a negative 420. Where is that in our cash flow statement? Ah, that makes sense. The notes payable went down from 400, but went down by 420,000. We must have paid some of that loan off. A reduction in cash. Okay, I got it. And then finally, look at look at common stock. Went from 460, as we showed earlier, to 1,680,000 common stock. Where is that on our cash flow statement? Ah, an increase in cash because we issued more stock. So the combination of all these things. Oh, look, here's one more. Go back to the income statement. There's our profit. That's naturally an increase in cash, $253,584. But you know what also is an increase in cash from this financial statement, income statement? Depreciation, $120,000. Look at it here. It's increase in cash on operations of $120,000 called depreciation. Wait a minute, Mr. Hasse. What's depreciation? Really? Yes, because depreciation is a journal entry where you're expensing an asset, but are you spending cash? No. You're expensing without spending cash. Wow. That's why it's positive cash flow. This company, accounting-wise, made $253,584, but cash-wise, they actually made $253,584 plus the depreciation amount. They actually made $373,584 in cash flow. Net income plus depreciation. Because depreciation is an expense, but you're not writing a check to Mr. or Mrs. Depreciation. So ladies and gentlemen, The cash flow statement is telling us that this company in 2019 had negative cash flow from operations, mainly because of receivables and inventory. They had positive cash flow from financing, mainly because they took in all that cash for selling the common stock. And they had negative cash flow from investing, where they purchased some more investments and they purchased some fixed assets. The net effect of all these is $6,718. And golly Gomer, there it is right there. Isn't accounting wonderful? The debits equal the credits and everything is in balance. All these transactions for 2019 are all summarized in that little number. And what does that tell us about the company? Excuse me, ladies, it sucks. They should be generating more cash flow. $6,700 of all that activity? Something's amiss. And you know what's amiss? They're not selling their inventory fast enough, and they're not collecting their money fast enough. That's holding back their cash flow. So even though the company had a nice profit in 2019 and their stock price went up, looking under the hood of this business, they have potential problems. They need to generate a lot more cash flow. And the reason they're not generating it is they got some collection and inventory management problems. And that's something to look at. That's what chapter 3 is all about. How accounting relates to finance. Let's take a look at a couple of problems from the end of chapter 3. I'm on page 79 of your textbook, the end of chapter 3, and I'm on page 79. Remember, these problems that I review in class mirror the type of questions you'll receive on the quiz, on the assignment next week. Okay. I'm looking at question 12 on page 79. Income versus cash flow. Something we just talked about. Income versus cash flow. Explain why accounting income generally differs from the firm's cash flows. Explain why accounting income generally differs from a firm's cash flows. We just saw that the company had $253,580 of profit in 2019, but they only generated $6,718 in cash flow. Can anybody tackle this answer for me? I'm not going to pick anybody. Can anybody explain why that is different?
I'll take a crack at it.
Go ahead, Erica.
So the income is just what's coming in to the company, and the cash flow is the in and the out.
Well, that's generally in big picture, yes. A little bit more specific, and I'll finish that thought where you were headed is. Remember, the accounting income is the difference between revenue and expenses as they're incurred during a 12-month period. But the cash flow is when we collect the money from that revenue. Remember the receivables?
Mm-hmm.
The cash flow, remember, is when we have to pay off debts, when we collect the money from investments. It's a whole bunch of different things. Remember, we just saw in operations, financing, and investments. So accounting income is telling us, oh yeah, we made $253,584, but we only generated $6,718 in cash because that accounting income was just revenue and expenses per the accounting generally accepted accounting principles. But the actual cash flow is what we collect of receivables, what we spend or what we owe money on, what we sell. Remember, a big portion of our cash flow in 2019 was the selling of that stock, receiving the cash. So cash flow is entirely different from accounting because it involves so many different sectors. And you were right, Erica. It's the coming in and out of cash. You're exactly right. It's the coming in and out of cash that has nothing to do with profits. It's the collecting of receivables. It's the selling of inventory. And that's an interesting thing. So one of the things, you got to remember this, one of the things that you got to think about is many times companies say, oh yeah, we did great last year. We had $4.2 billion in profit. Then you look at their financial statements and you see their cash flow was only $1 million. Huh? You made $4.2 billion and you only generated an additional $1 million. Where did that money go? Well, it's in receivable. It's in inventory. It's in debt. The finance person has to make sure they understand that. You. You have to understand that. The accountants provide you that data, but you have to understand, geez, why did we make $253,584? Well, yeah, we had revenues minus expenses. But how come our cash position didn't go up by that amount? Because we didn't collect the cash on some of those sales. It's sitting in receivable. Because we paid out cash to our vendors to buy inventory and we didn't sell it. And for all those other reasons. That's a key point for us as finance people to remember. Circle question 12. Make sure you understand that. You'll see that again next week. And let's take a look at another question from chapter 3. It's question number 17 at the bottom of page 79. Income versus cash flow. Following along the same lines that we just talked about, income versus cash flow. Startup firms typically have negative cash flow for several years. Let me explain that. In other words, you start a business, you put up the upfront money, you buy the assets, and it takes you a while to generate a profit, usually many years. So how do you function in those years? You have a significant enough of capital and cash to get you through those years until you start making a profit. I live in Claremont, and we have a street that goes east and west in Claremont called Arrow Highway, if any of you are familiar. And I sometimes go down Arrow Highway every now and then, and it's always an amazing drive, and here's why. As I'm going down Arrow Highway, at the corner of Arrow Highway and Indian Hill is a shopping center. Every time I go by that shopping center, they have different businesses in that shopping center. Hey, there used to be a dry cleaner there, now it's a donut shop. Hey, there used to be a 7-Eleven there, now it's a dollar store. That was just a few months ago. What's going on there? Because businesses, small businesses start up their businesses and they get a space in that shopping center and they don't have enough capital to generate cash flow even when they're starting up and they're losing money. They need cash flow, they need capital to keep them through until they generate business. And they go out of business and somebody else starts it up. I call Arrow Highway the interesting highway because I always see how the economy is really going. If you see a lot of stores or businesses changing or just boarding up, you know the economy is not doing too well. Guess what's happened on Arrow Highway lately? Some stores are going out of business. They don't have the capital to maintain the downturn in their revenue. So a startup firm typically has negative cash flow for several years. As I said, does this mean that they're failing? No, because it takes a while to generate business. Accounting profits for these firms are commonly negative. Yes. How would you interpret this pattern? Is there a shortcoming in our accounting rules? No. It just means that, remember, revenue is low. If it's high, you're going to lose money. How do you make up for that? You have significant enough of cash flow or capital to get you through until you start making a profit. Do you realize in America, 3 out of 5 small businesses fail within 18 months? 3 out of 5 small businesses kind of discourage you wanting to start a company. But you'll succeed if you have plenty of capital to get you through those lean times. And you have to show that in your business plan. So one of the key points of looking at these financial statements is knowing what's the difference between accounting profit and cash flow. Accounting profit is a 253,584. But that's a whole lot different than how much cash we're generating and showing in the cash flow statement. There's whole other processes of the business that are involved than just revenue and expenses. And a lot of times small business owners forget about that and they go out of business rather quickly. Okay, that's chapter 3. Now in 15 minutes, 20 minutes, can I get through chapter 4? I think so. Remember I said on page 105 of your textbook is a summary of performance measures. Let's take a look at that. Excuse me. Trying to find the page here, guys. Excuse me for a minute. Here we go. Damn it. There we go. I found it. I'm on page 105 of the textbook in chapter 4. And this is what chapters 4 is all about. In chapter 3, we're understanding what the financial information of the company is. In chapter 4, we're performing measurements of its activity. And they're in certain headlines. Performance measurement, profitability measurement, efficiency measurement, leverage measurement, and liquidity measurement. Excuse me. All these are ways of taking a look at the company's financial information on their income statement and balance sheet and comparing it to prior years or comparing it to your competitors. Remember, all publicly owned companies have to show their financial information to the world. One of the jobs that are a result of getting a business degree from the University of Laverne, it gives you the ability to become a financial analyst. And this is what financial analysts do. They take a look at data and put it into these different measurements to compare to the competition that you're in, or compare to your history, or compare to the industry you're in. We need to know a few of these for assignment number 1. Not all of them. Of course, assignment number 1 is open book anyway, so you can probably find these anyways. But if you go now back to this is where they're defined, how to calculate them, and they're defined in chapter 4. Now, if we go back to our financial statement that we looked at, and we click on Statement Analysis tab, I would like you in this next week, and I will post these answers by the weekend, is I would like you to find these information based on the company's financials that are given to you here. What is the current ratio in 2018 and 19? What is the debt ratio in 2018 and 19? And these are all defined in chapter 4. The profit margin, return on assets, price earnings ratio, earnings per share, average collection period, and inventory turnover. I want you to find these here. And then next week in class, I will provide the industry averages, and we'll talk about those definitions. What does it tell us? But if you'd like to, again, this is not for a grade. You don't have to do it if you don't want to, but you're going to have to do it on assignment 1 anyway, so you might as well practice it. I would like you to go to chapter 4 and find the definition of these things and look up, go into the financial area and find them. And I'll do the first one for you. The current ratio. The current ratio is the relationship between current assets and current liabilities. Current assets and current liabilities. So here I would go equals current assets for 2018, right there, divided by, oops, I make this a little bit easier so you guys can relate to it. All right. Current assets were 1,946,802. 1,946,802, and I divide that by current liabilities, 1,328,960. 1,328,960. And I get 1.46. In other words, the current assets are 1.46 greater than the current liabilities. The industry average for this market or this industry that this company in is 2.1. That's the industry average, which is pretty high. The current ratio. So I want you to find the current ratio for 2019. Then I want you to find all these other ones. All right. This is efficiency. Efficiency. So I want you to find these right here. I'll highlight them. That's what I want you to find out for if you want to. If you don't want to, that's okay. It's no grade. And then next week, I will post the answers by the weekend and we'll talk about this in class next Tuesday. What does it tell us? What does it mean? In assignment number 1, I'm going to give you a financial statement of a company. You're going to have to do these same things. All right? And this tells us about a company's liquidity, their debt position, their profitability. Many times if you go to the business newspapers or business channels, during every quarter, they have, oh, this is great, this is earnings week. And they say, okay, our profit margin this quarter was 3.4%. That's compared to 2.7% last quarter. So that tells the world, oh, we're making more money. So what does this information tell us? And this information leads us into other things as we move farther down the class. So let's take a look at another problem in chapter 4 that also practices this. On page 111, problem number 7. All right, and let me bring that up. Page 111 of your textbook, problem number 7. Here, I also give you the financial information of a company called the Phone Corporation. Well, that's a distinguished name. The Phone Corporation. There's their income statement. There's their balance sheet. And it asks you to find all these different numbers. All right? This is good practice. I will post these answers also by Friday. This is good practice for you. Question 7 on page 111 and 112, and it asks you to find this bits of information here in this information, just like you're doing with the in-class worksheet we did this evening. This is more practice for you. So if you'd like to practice these, because again, you are going to see a problem like this in assignment 1. And what this tells us is us as finance people, the ability to read information and have it tell us something from the accounting data that told us what happened. What happened. So those are two things for you to do with not for a grade. The only graded work you have this week is to schedule an appointment and talk to me. But if you want to practice these, I will post the solutions by the weekend, and we're going to talk about this next week as a prelude to assignment number 1. What can we learn from the accounting information of a company? Question 7 in chapter 4, and our in-class work that we just did tonight. Try to do those 2 things, or do one of them. If you don't have enough time, don't do both of them, but try to do them by the weekend, and I'm going to post the solutions for you. Again, I don't want to get any emails from somebody saying, where do I post this data to? When do you want it, Mr. Hassey? I don't. You don't have this not for a grade. You don't. You need to listen. This is not for a grade. This is practice, and we will go over this next week in class. My subject of my week 3 introduction video is talking about this problem. That's my introduction to week 3, is showing these answers and what does it tell us about financial information. So now you guys are no longer accountants, you're financial analysts. And from that, we learn and we move on to other topics that are still to come in our class. I think this is pretty exciting. I'm telling you, when I get done with class tonight and I finish all my note taking, I'm going to stay up till about 2 or 3 in the morning and just look at these financial numbers. I can't think of anything more exciting. I hope you guys aren't buying that. Okay. So there's that. Okay. There's the good-looking group again. Anybody have any questions? Okay. Remember, we have office hours on Thursday afternoons from 3 to 5. If you want to start doing these problems and they're just not working for you, we can talk about them during the office hours. I will post the answers to a couple of these problems by probably Friday afternoon, and you can review them. But we're all going to review these and discuss them next Tuesday in class. And as I said earlier, your only graded work this week is to schedule an appointment with me so we can chat. I want to know 3 things. Are you a Dodger fan? Your social security number? And are you a Republican or a Democrat? Kind of personal. If you don't want to tell me that information, you don't have to worry about it. Dodger fan, social security number, Republican or Democrat? I'm just teasing, guys. You don't have to tell me that stuff. Especially if you're a Republican. Then I don't even want to talk to you anymore. That's a joke. Okay. That's a joke. If we get to start talking about politics in this class, it's all over but the crying. So we're going to stay away from it. Vince Wainwright, for a 3rd time, are you online right now? Vince. You see, guys, I've had this guy in a prior class. He shows his face that he's online, and then he's not online. He's off. He's doing something else. See, I got him again. See, I got him again. I had a class last spring with this dude. He shows, you see his picture there, Vince Wainwright. There he is right there. See, Layla's there. I know Elliot's there. Ben's here. Everybody else is here. But then Vince, there's his picture. Vince, are you here? Can you answer this question? He's trying to get away with it again in another class. Vince, you're going to watch this recording and you know the gig is up. And when you and I talk this week, it's going to get ugly. All right. Edith, you have any questions, dear? Edith. Edith Roman. Edith, do you have any questions?
No questions.
Thank you, Edith. All right, guys. Again, I have recorded this for this evening. You have a couple of review work to do, but no grade. And I will see most of you by next Saturday afternoon in our guide to personal discussions with yours truly. Dustin, your task in the next week is to find a different background that's not freaking me out. Okay, that's your job. Look at William. He's sitting out in the patio. He's relaxing. There's no screaming dogs or cats. He's enjoying it. All right. Well, if nobody has anything, I'll let you all loose. As I said earlier, I stay on a little bit longer. If any of you have questions or comments, please feel free. I'll stay on. If not, I'll see you all in our interview sessions in the next few days, and see you again next Tuesday night. Adios, everybody. Thank you.
Bye.
Bye-bye, Christine.
Bye.
Professor Hussey, in
Ashley.
in your bio, you said you were a hockey fan. Which hockey team?
Well, Ashley, how I funded my college education was I got a hockey scholarship to a Division I school called St. Lawrence University, which none of you probably ever heard of, but that's okay. But I grew up in Detroit, Michigan, and my team is the Detroit Red Wings.
Okay, as long as it's not the Ducks, we're good.
No, it's not the Ducks, even though I do enjoy going to Duck games better than I do going to King games. But Detroit, any sports team from Detroit, that means I'm a loser, I'm a fan of. Red Wings, Tigers, Lions, Pistons. It's been a tough year. So, but the Red Wings is my hockey team, Ashley. What
Okay.
team are you for? The Kings?
The Kings.
Yes.
But I have to say that it is a lot easier to get in and out of the pond than it is the Staples Center.
Amen to that. I totally agree with you. You're right.
All right, I just wanted to know.
Okay, see ya.
Bye.
Bye, Erica. Take care.
Professor,
Yes, Carl.
I was going back to last week. You said that if we don't need the book, we don't have to get the book. Should
Yes.
I get the book?
Carl, if you don't want to, because I show you the problems that we go over here in class,
Okay.
the answers are provided also. So, you know, if you can afford it, Carl, and you want to make the investment, fine. But I give you PowerPoints, I give you all the explanations in Blackboard. You know, if you can save some money, do it. Okay.
Okay. Okay.
You're
I was
not.
just
It's
a
not
little
going to
worried
hurt you.
about it. Okay.
Yeah, it's not going to hurt you. Okay.
Okay.
And I'll be honest with you, Carl. If I thought you needed the book, I would tell you to get the book.
Okay, Professor.
Okay. Okay.
Thank you so much.
Very good, Carl.
Thank you.
All right.
Yeah.
And for the scheduled timing,
Yes.
do we do that in the Blackboard or do you just
Yes.
shoot your email?
No, go to the Blackboard to the discussion forum and create a forum and says, Mr. Hassey, I'd like this date and time, and then I'll log it in. Okay.
Okay.
All right, Carl. Take
Thank
care.
you. Thank you. Bye.
Layla, you should go first. You had the question first at the beginning of class.
Go, Layla.
Okay. I was wondering if, because you didn't put my time, if you can just save me that 4:30, because it's really hard for me to do any times that are early.
4:30 on what day?
4:20 on Wednesday.
4:20 on Wednesday, Layla. You're down. I'll put it down there, okay? Thank you.
All right. Thank you. Have a
Don't
good
worry
night.
about it. Thanks, Layla.
Bye.
Have a good night. And I was
you.
wondering if the 2 o'clock slot was still open
2 o'clock on what day?
tomorrow.
Let's take a look. Hang on. Bringing it up now. Hang on. Okay, let's take a look. 2 o'clock slot is open tomorrow, Erica, so I'll put you down for that, okay?
And then Layla down for the 4:20.
Right.
Awesome. I appreciate it very much, Professor. You have a great evening. And
Okay.
well, I guess I'll talk to you tomorrow.
I will talk to you tomorrow. Thanks, Erica.
Good
Talk to you
night.
then. Bye-bye. See, Vince, you're on, but you're not. You got to fix that, buddy. You're in big trouble. All right, everybody, we are closing off for the evening. Okay, Kathy, hang on. How about 3:20 tomorrow, Kathy? 3:20 tomorrow, Kathy. 3:20. $3:20 tomorrow, Kathy. I'll put you down. Sorry about that. Okay. The number is if you you can't do the Zoom thing, so you need a phone number. Hang on, I can get that phone number for you. I'll have to email it to you, Kathy. I'll give you a phone number to call in for that meeting. Okay. I'll email it to you after class. Okay. Okay. Talk to you later, Kathy. Bye-bye.